Good morning, everyone. Welcome to Windsor Brokers live daily market outlook. Today is Monday, 5th of November 2012. We are at the beginning of the new week with what happened last Friday, seeing a continuation during the Asian session and the beginning of European session. Dollar's positive sentiment established and boosted actually after U.S. jobs data that report that highlighted the relatively solid U.S. economic fundamentals as U.S. employers stepped up hiring in October. 171,000 employees, beating even the most optimistic forecast, with the jobless rate raising a tenth of point to 7.9%. But this was because of more people were looking for the job. As immediate reaction, the US dollar on its Friday's rally hit 2-month high against a basket of major currencies, extending, of course, its gains during the overnight session and now beginning of European session, as I said, with the 4 months hitting 4 months high against Japanese yen. With euro also being hit as the current action shows attempt through 128 psychological support and base, as well as dollar Swiss testing its double top strong barrier at 94.30 zone, while the commodities sank. The crude oil is currently below 85, support attempting at the last week's low at 84.67, and the gold steadily the lower 1675 is testing basically its last Friday's low as strong dollar pushes the major counterparts and the commodities to the lower levels. It seems that we are facing now one of the major breakouts in the short-term action for a number of currencies. Basically, it seems that the current action, of course, with some further movements, it will be seen as a trigger for some major corrective action and the basically changing of the direction of a number of instruments. We'll focus today on our majors, of course, and the commodities, and see what are the forecasts and what we can expect. Basically, current structure shows quite a strong bearish tone on the dollar, on the euro, and the sterling, as well as commodities, while the dollar remains well supported. And basically, we're at the break point on the euro, on I would say minor break point on the sterling, but dollar Swiss is at the break point, while dollar yen is currently, I would say, rather in corrective mode, as the larger picture still shows bulls well in play and probably looking for a further extension higher. We'll take a look more detailed look on this in our technical part. Again, we have a problem with our calendar due to some technical issues, and our technicians are working in solving this. Important to mention for today is the Eurozone Centix investor confidence that is due at 9 o'clock GMT, and the forecast is minus 20 compared to minus 22. This is November's release, minus 22.2 in October 1, meaning that certain improvement in the confidence is seen, expected for today's release. From Spain, unemployment change, they jumped to 128.2 thousand compared to 90.3 thousand in the month of September, and the forecast, and the 79.6 thousand in the month of September. I would say these are the quite significant releases. And of course, from afternoon we have US ISM non-farm manufacturing PMI for October. A slight decrease is seen on today's forecast, 54.5 compared to 55.1 on September's release. Not much seen in today's releases. So basically, we'll be looking at we missed to say the UK's market services PMI for October, that is due at 9:28 GMT, shows a slight decrease in the services PMI of 52.0 is today's consensus compared to September's release at 52.2, and these should be the highlights of today. We have the PMI from UK and the investors' confidence from Eurozone, and the non-manufacturing PMI from US, and that will be the most important releases for Monday, 5th of November 2012. We're going to move now to technicals and see. I know that you are all waiting for this, see what's going on in the markets and what we can expect in the coming hours or during today's day. So starting with the single currency, first of all, we're going to take a look on the trend studies. We can see that according to the ADX on 4-hour chart, bears are now fully in control. Even on 1 hour that there was a brief corrective action above 128 overnight to 128.40, and now fresh slide lower brings near-term bears fully in play. A very significant point is seen on the daily chart, where now we are facing the break below the base, approximately 5 weeks base at 128.00, as well as 200 days moving average that is at 128.29, and basically last Friday's close, weekly close, just one tick below this level, is a good bearish signal for possible further extension higher. Also, the significant point is break below 128, clear break. Now we have 127.80 seen so far. Would be also confirmation of the bearish pattern of double top seen at 131.70 and 131.38. That might be trigger for a stronger, basically break above below 128 is seen as a trigger for stronger corrective action of a broader rally from 120.42 to 131.70, with immediate support now seen at 127.45. These are the mid-June peaks, as well as 127.39 is the 38.2% Fibonacci retracement of 120.42 to 131.70 rally. These will be our next immediate targets on the downside, with further extension lower seen, not ruled out on the acceleration. Hourly structure is a bit extended at this point, but all indicators are still pointing lower despite being in oversold zone. 4-hour structure also fully bearish. Again, no any signal of reversal, with all indicators firmly pointing lower. And as said, important is breakout of 128.00, as they also signals break of the daily indicators, as MACD is now below its midline, and the momentum also turning lower. RSI is at 25 days is moving lower. So basically we have all indicators on the lower and larger time frames now in the bearish mode. Of course, the hourlies overextended conditions definitely will be seeing some corrective action, yet no any signal seen on even on the hourlies. From Ichimoku studies, bears are firmly in play in the 4-hour chart, with the daily structure now deeply in the cloud. We need to see the break below 126.06, where is the daily cloud base, in order to confirm the Ichimoku studies being firmly bearish in the daily chart. Just to take a quick look again on the trend ones, as said, we are the bears are firmly in control. On the upside, as the pair actually now is testing the channel support, as we can see, this is the channel of 131.38. Break here is one of the another bearish elements. On the upside, 128.30 as previous strong supports now are acting as resistances, with the previous strong support at 128.80, 129.00 now seen as good resistance, and should in any case cap any stronger bounce. In case of any stronger bounce higher, this should be capped by 128 to 129.00 in case we see the break above 128 to 128.30. To resume, the negative sentiment on euro dollar remains, especially in light of breaking below important 128 base. That might be trigger for major corrective action of larger 120.42 to 131.70 with the targets downside, immediate target at 127.45 June highs and Fibonacci 38.2% retracement. Sterling also fully retraced and now broke below 160.00 on its last Friday's acceleration following the jobs data. Basically, it was in this good corrective action of 159.11 with the higher low being posted on 29th of October at 160.05, and the brief break higher basically failed to test and break our upside target at 161.78, 161.74 seen before the bears took control, and then acceleration seen on last Friday's release of US jobs data, initially fully retracing a 160.05 to 161.74 rally with this morning's fresh weakness extension. That was basically expected on quite a negative structure with the brief corrective action. We mentioned this in our this morning's analysis that some corrective action might be seen. This is actually what happened during the Asian session from 160.06 to a minor correction to 160.38 after bears reasserted and took control. 159.89 seen so far. Most likely we'll be looking for acceleration lower, and the immediate target is 159.74. This is the low of 10th of October 2012. And basically our main target will be 159.11, a low of 23rd of October 2012. Daily structure is now losing traction as a part of the larger down move from 163.08 with the loss of 160.00 as initial support. Now the indicators are moving into the negative territory, and they're looking for test of a very strong support at 159 zone. We have 38.2% Fibonacci retracement of the broader 152.67 to 163.08 rally, and also the low of 23rd of October 2012. A break here could be quite risky, as it will risk a test of initially 90 days moving average at 158.76 and the 200 days moving average at 158.43. Break below 159 also to confirm the double top at 161.78.74. That will be again another bearish signal for possible further extension lower, and the set 90 and the 200 days moving averages would be the likely targets. Negative tone dominates on the Ichimoku studies as the price is firmly below the moving averages and as well as cloud, while dailies now is in the cloud, and the cloud base at 158.82, loss of which will be signal that bears are fully in control according to the Ichimoku studies. Trend studies showing bears fully in play on the 4-hour chart as well as in hourly. While daily is still not clear, we need to see the break below 159 in order to confirm the bearish structure on the daily chart. Still sideways in the daily structure is still in the sideways move within the 159 and the 161.74 congestive range. Break below 159 is to confirm bearish structure and basically confirm the major corrective action of larger 152.67 to 163.08 rally. Dollar yen, as I mentioned at the beginning, is in the corrective action of 80.67 last Friday's fresh peak. Basically, the pair tested our initial target at 80.65, the previous high of 25th of June, as well as 50% retracement of larger 84.17 yearly peak to 77.12 low of 9th of September 2012. The daily bulls are still firmly in play, although quite extended. The conditions might be suggesting some corrective action, yet no any reversal signal seen on the daily chart. From the other side, the reversal on the hourly has weakened briefly the hourly studies as they emerged out of the overbought territory, with the main risk seen on a lower top left during the night at 80.55 and fresh slide that is now testing 80.25 55 days exponential moving average on the daily chart with the crossover of 10 over 20 exponential moving averages, seeing more pressure towards the downside. However, I would say the good support we see at 80.14 shown on the 4-hour chart, which marks a 38.2% retracement of the initial rally from 79.27 to 80.67, and it's reinforced by 20 days exponential moving average, along with the 50% retracement at approximately 80.00. That acts also as a psychological support, and ideally any dips should be contained at or above these levels in order to keep the near-term bullish structure in play. The previous initial support and previous high at 80.37 has now been cracked, so we might see extension lower to ideal reversal point at 80.00. Any break here, I would say, would prolong the current, actually would delay the current bullish structure in favor of stronger correction, while loss of 79.80 that marks as 61.8% retracement would, I would say at this point, highlight. I would like to highlight it would delay. We'll put near-term bulls aside in favor of stronger corrective action. For now, it's still quite a positive tone as momentum is starting to move higher on the hourly chart, and the basically signal of initial reversal seen on stochastic sees quite good potential for a reversal above our ideal point at 80.00, 80.14 for resumption of the broader uptrend, as break above 80.67 and our recent high posted last Friday, seen opening next levels at 81.00 as around figure resistance, and probable possible extension up to 61.8% retracement at 81.48. And from majors, the last one is the dollar Swiss, currently testing. Actually, the barrier has been already cracked. 94.36, 94.30 previous highs are giving way for a possible further extension higher. The positive tone established of 92.75 in the near term. This is the lower higher low of 31st of October 2012. Extended gains through important barriers of 93.85. Again, we have it. Okay, 93.85 previous highs. That also marks 200 days moving average, and 23.6% of the initial 99.70 to 92.13 descent, basically extending its the third wave of the corrective action of 92.13. The first one was capped at 93.85, then corrective action lower found a footstep at 92.75 with break above 92.85 and 93.85 and 94.00 with the weekly close above 200 days moving average and above 94 as psychological level, seen quite supportive for possible further extension higher. Fresh momentum seen on the daily chart, and the MACD approaching its midline sees now potential of firm break above this congestion between 94.30 and 92.13. That will be signaling, confirming basically the bottom at 92 zone, and to open way for a stronger corrective action. Immediate target is at 95.00. It's 38.2% Fibonacci retracement of 99.70 to 92.13 descent, above which we have 95.40, 90 days moving averages shown on the daily chart. On the downside, overnight's lows at approximately 94.00, which is also acting as a psychological support, along with the 200 days moving average and the previous peaks at 93.85, offering quite good support, and any dips should not exceed this level. Ideally should reverse at or above these levels in order to maintain the current bullish structure. For the major break above 94.30-36 double top, previous double top, now it's already been cracked, in order to signal stronger and major corrective action of 99.70 to 92.13 descent. And finally, we're going to take a look at commodities. Crude oil is in the steep descent again, following a brief corrective consolidative action, I would say rather, of 84.67, 29th of October, a low that stalled at 87.37, short of our initial barriers, 87.70 we mentioned in our several sessions and in written analysis that any recovery, stronger recovery requires regain of minimum 87.70, 88.00. That marks 38.2% Fibonacci retracement of the previous down leg from 93.47 down to 84.67. Unfortunately, the failure occurred here as descending 55 days exponential moving average limited gains, and a fresh slide lower is now below 85.00 and below 84.67, seeing more potential towards the downside as a part of the larger downtrend from 100.72 low, peak of 14th of September 2012. As I mentioned, we are now in the third wave of 100.72 according to the projected projection of the current slide. We will be looking for extension down towards 80.50. That's projected level of the wave C from 100.72 down to initially wave A ended at 87.69. Then corrective second wave was capped at 93.50, and finally the third one is now looking for extension towards 80.50. This is the projected level with interim support, quite good support, higher platform at approximately 83.60.70. These are the beginning of July lows seen as interim support on en route towards 80.50, and possible extension down to the 77.27 yearly low posted on 28th of June 2012 has seen, not ruled out. Daily structure is firmly negative, along with the lower time frame studies that with the 4-hour ones now pointing lower and being below their midlines, while hourlies are quite extended at this point, yet no any signal of reversal, so we might see the ride down to 83.64 easily during the session. Overnight's peak at 85.19 now acts as initial resistance on the hourly chart, reinforced by descending 20 days moving average. In any case, any break above 88.00 is expected to provide near-term relief and prevent bear from the further slide. Otherwise, bears remain firmly in play, especially that currently stronger dollar and the current crisis worldwide sees further fears of lower demand for the energies that pushes the price lower. As brief relief was given to the crude oil last week's release of crude oil inventories that unexpectedly showed the draw in the crude stocks, but this was short-lived as overall bears again took control and will be likely looking for extension down to 83.64, probably 80.50 seen on the break. And finally, the yellow metal that lost ground and dipped to a fresh lows this morning. 16.72.50 is the fresh low. The major breakout was seen below 1700, 1690. This is what we mentioned last Friday. I think that will be trigger. This is also 50% retracement, psychological support, and the previous base. Now it's main acceleration lower, targeting a cluster of strong supports already being dented. 90 days moving averages out at approximately 1676. The next one we have 1668, Fibonacci 61.8% retracement, and the 1663, which is the 200 days moving average. Reversal of 1795 yearly peak is now accelerating, and basically a break below 200 days moving average would be a signal for some stronger corrective action. Also confirmation seen on the daily Ichimoku studies as the price now emerges out of the Ichimoku cloud. This was one of the elements of the strong 1660, 1670 support that I mentioned in several of our previous sessions and written analysis, and basically this could be quite risky as break below the 200 days moving average at 1663 would be likely looking for a test of 1600 previous highs of month of July, as well as psychological support that might come in the near-term focus in case of losing 200 days moving average. Overextended hourly conditions, yet not showing any reversal signal, but momentum is slightly ticking higher at this point, with the MACD also pointing higher. Might be signal for a brief pause in the current strong downtrend with the some technical buying pushing the price higher in the corrective action. Previous peak of daily high actually at approximately 1684 now offers initial resistance ahead of 1700 psychological resistance, and 1698, 1700 break above 1726, 1730 on the upside. That was initially our break point, would provide relief, but for now I would say the 1700 should act as a good resistance, probably to extend to 1710, but we don't see much more towards the much more action towards the upside with the 1707 main trend line resistance seen capping any stronger bounce and any break above psychological 1700 barrier. That was, I think we covered everything. That was all from my side. If you have any questions, if you want any other instrument or anything, you can submit your questions now. Okay, it seems that we don't have questions. I hope we covered all important elements, as really we are now in the certain break point for the major for the number of instruments, and we have to be quite careful at these points, as further acceleration might be signal for a major reversal for a number of majors and the commodities. Thank you very much for being with us, and we expect you again tomorrow morning at the same time at 8 o'clock GMT, 10 o'clock local Cyprus time. Wish you a nice day and profitable and successful trading. Go with the trend, and you will not miss it. Thank you.